Welcome to Buy, Hold, Sell. Investors are always after reliable and steady income streams. They've come always in the form of utility stocks, infrastructure stocks and REITs. And there's been a real bump in those lately with expectations of further rate cuts and rallies in the bond market providing better gains in these stocks. To talk about these today, we've got Michelle Lopez from Aberdeen and Shane Fitzgerald from Monash. Welcome both. Shane, I'll start with you. Yep. Is this an area that you like and invest in?
It's an area our fund invests in a lot. We're more about finding stocks going for a step change in their outlooks and hence share price re-ratings. And you don't tend to see that in these companies, but I can really understand why they are attractive to people, particularly yield-focused investors looking for solid income returns. Yeah,
sure. Now, Michelle, is it a space that you can see appeal for your funds?
There's a part, yes, where it plays, which is the defensive bucket within the portfolio, but perhaps it's important to understand why these sectors and these stocks specifically are more sensitive to interest rate changes. And if we take a step back, and we have seen expectations now moving forward are for negative interest rate revisions, and that has moved the bond yields. So the valuation in that causes a negative correlation between bond yields and valuations, and since January this year, what we've seen is the Fed come out and change their stance. So they've gone from an easing to, a tightening to an easing, and that's called valuation uplift in a number of these companies.
So it's a nice safe place to be for a period of time with a view on bonds. Obviously that highlights some of the risks as well.
Absolutely, and I think the important thing to note here is there's two parts to this part of the market. You've got the cyclical upswing that you get from lower discount rates, but then you've also got to consider the underlying fundamentals of each and every one of these investments, and that part is going to become more important given we've already seen the re-rating happen from the cyclical part of it.
Right. Shane, so the risks are there as well. I mean, it's a nice income story, but capital risk exists. What are the pros and cons investors should be aware of?
Well, look, the pros are pretty obvious. They tend to be very stable, predictable earning streams you get from these companies. You also get a play on population growth generally coming through on these stocks as well. And the other thing I think is a key positive of investors as well is they have very low betas, so they're very uncorrelated to the market generally. So that adds to that defensive characteristics. On the cons in the sector, look, I think the three things you've got to look out for is a number of these type of assets have a shadow tariff or a regulatory rate of return attached to them. And it's during review periods of those that you've got to be careful, because that tends to be a political process and we know what that can do. The other two things you've got to look out for, I think, also is when these stocks are in their CapEx phase, that is investing in, they're very asset heavy businesses.
Right, yeah.
So when that investment phase, they can struggle. It's more when they're in the harvest phase that they do well. And the final thing I'd also point out to as something you've got to look out for is when they're in the ramp up phase of those assets.
Right.
And you can just go look at toll roads. Often on toll roads, it's the second or the third owner of the asset that has actually done well. So the ramp-up profiles can be a bit sketchy.
Yeah, the pricing can be wrong, and those numbers.
The assumptions on the usage rates, all these things. They're modelled on the spreadsheet, but when you get into the real world, often those spreadsheets can be thrown out.
Yeah, excellent. That's great. Talking valuation, Michelle. I mean, right now with that move that you mentioned, with bond yields and the follow-on move in all these kinds of stocks. Is there value in this space now?
Sure, well, the metrics we use to value these stocks, so if I consider the utilities and the infrastructure space, you tend to look at DCFs, dividend yields, and metrics against peers, so EV to RAB, so regulated asset base, to Shane's point there, and the EV to EBITDA. On the REIT side, it's dividend yield and price to NTA or price to net asset value. So if you pull all that together, the sector is looking rather expensive. And to my point previously was you need to disengage or dismediate between the valuation uplift from the cyclical component and look more at the fundamentals. Yeah. The other thing to note as well from a valuation perspective is in the past, historically, these valuations have risen when bond yields fall, but that's also coincided with very strong top-line growth in a number of these players.
Growth happening as well.
Correct.
Helps a lot of those assets.
Absolutely. And going forward, we question whether that growth will remain. So we really need to look a lot more at the fundamentals.
Okay, great. Shane, obviously Michelle's not seeing a lot of value there.
Yep.
Is there a different point of view you guys have got?
No, we would say that it's outright expensive. I can see why they're trading on these sort of multiples, given markets desire to have defensive asset classes, if you like. But we just don't think there's any margin for safety whatsoever at this point. So we much prefer to play the sectors otherwise.
Even if the bond market rallied further, would you see valuations increase?
Look, but you're going to get the same sort of valuation in any long duration stock.
Yeah, sure.
Right, so given a lot of these stocks are priced to, in my view, an inch of their life in some respects, any hiccup of any kind can be pretty bad.
Now this might be hard based on that view, but is there a single stock in either of these sectors we can find that would be a buy?
Yeah, look, the one that we would point out would be ServiceStream. It's not an infrastructure play, but it services these infrastructure plays. It's had, exceptionally well-managed company. It's got very strong growth coming from the NBN rollout, and as that moves into the maintenance and remediation phase, they're likely to pick up an even greater share of that CapEx from the NBN. And they're now getting half their income revenues now coming from water infrastructure.
Yes.
And that's a very ageing system. A lot of CapEx going to go in that in the coming years. And, it's not a sexy part for government to spend money on, but it needs to be done.
It's not got to make money, that's the thing, isn't it? ServiceStream from Shane. Michelle, a favourite of yours?
We're still seeing very good buying opportunity in Auckland International Airport.
Good, okay.
And here's an example of a defensive company that has a regulated asset base in the aeronautical earnings, but also an opportunity for significant capital return. And that comes from sort of three buckets within it. So they've spent a lot of CapEx. So going forward in 3 years, there's going to be a uplift in the regulated asset base. So that's the first and probably the largest component. The second part is the CapEx that they've poured into their retail offering. Again, that's going to offer quite significant earnings growth over the next 2 years. And then finally, the part that's probably mispriced by the market is the land bank that they're currently sitting on. So they've got a decade worth of redevelopment available, and on our numbers, the land bank looks to be, up to $1 billion undervalued.
Wow, okay.
So again, that's an example that you can play the defensive and the capital growth story.
And the council's still owning a lot of that
Correct.
stock, so it's
Yes.
nice and tight, which we like. Terrific. Well, investors will always want stability in returns. Obviously, price is what you need to consider, and there's a good few considerations from our panel today.